Okay. And then the liabilities also, guys, we can divide liabilities into two portions. Short term, we're going to understand this when we start discussing financial accounting, and long term. Got it? So bonds fall in where? Here we go with the bonds. Okay, so you are going to identify the bonds, you're going to find the bonds in a long-term part of liabilities of a corporation balance sheet. Okay?
Sorry, we're assuming that we're the company's the one issuing the bond, right?
Yes,
So
we're
like it,
assuming,
they could,
yes, this
yeah,
needs to be issued. Okay, so we're
yeah,
assuming that corporations have issued a bond, or they have
okay,
capacity, or they have knowledge how to issue a bond. Okay, but
yeah,
this is
yeah,
the focus here.
because I assume like you can also make like bonds can also be an asset if you're the one who bought the bond.
Right.
Yeah.
Yes, that's right. But bonds, remember, guys, are debt instruments. Okay, so in terms of priority with respect to shareholders' equity, they have priority with respect to these guys. Do you agree? So if something happens with corporation, the ones that are paid first are the bondholders. Okay. Now, when you talk about bonds, guys, you always talk about these credit ratings. I'm pretty sure you have heard about them. All the time that the people talk, so you know what, the credit ratings of a corporation's bonds, and we're going to be talking, and the people talk about SP, so they are the indices, okay, the SP and the Fitch ratings. So these are two main providers of credit ratings, and then of course we have Moody's. Okay, so these guys are the ones that really provide all the information. Now, how corporations are ranked for SP 500 and Fitch? Basically, you have the following. You have AAA, you have AA, you have A, and then you have BBB, you have BB, and then you have B, and then you guys have CCC, CC, yeah, there's no more space, and D, right? These are the ratings according to, if you are AAA, of course, you are a very solid corporation. And of course, the interest rate for a very, very solid corporation on bonds is very low, right? And you can go into the default ones. And some people invest on them, believe me, because default doesn't mean that you're not going to recover the money. It's going to be harder, but if you see that there is a lot of potential, you can buy bonds at a very, very deep discount. Now, Moody's has a similar rating, but they use a different letter. So they use, for example, for this one is going to be AA, AA, and A. So this is going to be BAA, BA, and B. And this one here is going to be CAA, CA, and C. And this one here is, well, D. Okay. So also, guys, if you're going to hear always investment grade bonds, for example. So when you hear about investment grade bonds, so these are the investment grade bonds. These one here are called speculative. And these guys are called junk bonds. Okay. So this is more or less what the people look when you want to have a bond, you want to buy a bond, you go to a corporation and see where the corporation is ranked. And as soon as you understand more or less the corporation is ranked, you more or less know what is going to be the interest rate that you're going to be requiring from this bond. Got it? So that's the way. Makes sense? Now, perhaps let's talk a little about the components of a bond. The bond, guys, has something that is called the face value. Okay, so what is the face value? You remember, guys, a bond in the past was a document. Okay, and in the document you have a number here that tell you how much was the face value of this. So imagine $100. Okay, so what is the face value, guys? It's simply the number that appeared in the document. Now everything is electronic, but if you go to developing countries, you still find bonds. You still find the physical papers, right? And what you see in this paper is what is called the face value. Okay. Then you have the price. And we're going to distinguish between the fair face value and price. Price is what you actually pay for the bond. Okay. What actually pay for the bond. Okay. We are going to have obviously the interest. The interest in bonds, guys, they have a particular name. They are called coupons. Okay. And the interest rate. So remember that interest is dollar based or is currency based. An interest rate that is a percentage. This is called the coupon rate. Okay. Now, what is important, guys, is I will write this as C percentage. This one is going to be called C. What is interesting, guys, is that the coupon rate is called coupon rate because this is the one that we're going to use to compute the coupons. Got it? So coupon rate, guys, is the one that we use, is the rate that we use to compute the coupons. There is another component, guys, that of course is maturity. So you need to know how long you're going to keep your bond. So the bond matures in 3 years, 5 years, 30 years. Okay. Now, as we're going to see in the class, guys, that if you buy a bond and the bond market is liquid, so you can sell your bond before going to maturity. Got it? But if you just want to buy the bond and keep the bond for all its maturity, you simply keep the bond for 3, 5, 4 years. Right? So this is the maturity. And there is another component, guys, that is really important. And it's called the yield to maturity. What we call YTM. So what is the YTM? The YTM, guys, is the market percentage rate available at any available at time t. So remember, the yield, the coupon, is something that is fixed at the very beginning. So when you buy a bond, you know what is going to be the yield: 3% per year, or 2% per each quarter, etc. So this is given. But in order to price your bond, you need to have something that's called a yield to maturity. This is simply an interest rate that is fixed in the market. How the market sets this number here? Well, it sets basically based on this table here, credit ratings, but also based on different economic situations. For example, when there was a March, remember the equity market was collapsing. So when the equity market was collapsing, the money doesn't disappear. The money needs to go back again to work. So the money goes normally into bonds, fixed income instruments. Got it? So, and the yield changes. Okay. So the more the people like or like bonds, what happens with the yield to maturity? Obviously, it's going to what?
It's going to go down.
It's going to go down.
So
exactly.
The more you pay, the less you get from it.
That's completely right. So basically, guys, let's talk a little more about this one. So let's talk about the yield. Okay, the yield by definition, guys, is going to be equal to the coupon over the price. So this price, this coupon, where's my coupon here? This coupon over this price. And so from here, guys, what you can see is the yield is a function of coupon and price, correct? So coupon is positive, price is negative. If the price goes up, what happens with the yield? Guys, if this part here in the denominator goes up, what happens with the yield?
It goes down.
Goes down. So that's why we have this negative number here. And normally why price goes up, one of the reasons, very simple economics, is when the demand of bonds increases, what happens with the price? The price increases, do you agree?
Yeah.
And as soon as the price increases, what happens then? So let me move this here. So then what happens? Yield decreases. Okay. Make sense to you guys? Make sense to everyone?
Yeah.
Okay. Questions up to now? Now, there is also another relationship, guys, of the price. The price is another function. So when I say G, guys, it can be a linear function, quadratic function, etc., of the interests, of the interest rates. And this is negative. What is this interest rate, guys? Normally, this interest rate is a Fed rates. Okay, normally the people consider the 2 or 10 years Fed rates. So what happens when the interest rate, the Fed rates increases? So let's analyze this. What happens if interest rate increases? So the Fed increases the interest rate. The prices,
the bond price goes down.
Goes down, and as soon as the prices goes down, what happens with the yield?
It increases.
Exactly. Exactly. Now the reverse happens for if the interest rate goes down, correct? If the interest goes down, the price goes up, and yield goes down. Make sense to you?
Yes.
So this one here is a good market for buyers. If you are buying, if you want to buy a bond, this is the time to buy a bond, because the price increases, your yield is going to increase. Because a coupon normally is fixed, guys. Or normally bonds have a fixed coupon. There are more sophisticated bonds that change the yield, sorry, the coupon, but in general, coupons are fixed. So that the change is price. And if price goes up, this is good for the seller, do you agree? So if you have a bond, it's time to sell. Well, I'm exaggerating, time to sell, but you have more incentives to sell. Makes sense. So this is the way that the relationship flows. Is the interest rate increases prices, or no, move prices, prices move yields, and the yields move the decision rules of individuals. Make sense? Guys, questions? Okay, so now let's talk a little about pricing of, no, not pricing. Yeah, let's talk about prices. I think this is 5. Let's talk about prices, okay? So, guys, let's do the following. Let's do a very simple exercise. So imagine that you want to know what is the price of the bond, okay? And my bond is a very simple bond. It has only 3 payments. 10, the coupon is 10. And at the end of the day, I will have my I will receive my face value plus my last coupon, okay? So in this case, this one here is my face value. This 10 is my coupon. So guys, what is my coupon rate? Given this information, what is my coupon rate?
$10%.
Exactly. The coupon rate is 10%. Right? So if we call these years, so this coupon rate is going to be, for this example, the bond is going to pay me a 10% annual for a face value of 100. Got it? So, but if I know that the face value is 100, why I don't simply write here 100? Do you see? And that's the question. So P depends on what? How do you compute P? For computing P, guys, you don't use the C. You use the yield to maturity. Okay? So this is the one that you use. Because remember, how do you compute prices, guys? If you have this cash flow, how do you compute the price? What is the exercise you're going to be doing? We have been doing these exercises for almost 3 classes already.
Discounting or?
Exactly, that's it. We discount. Correct? We discount, that's all. What is the missing element here for discounting?
The rate, the interest rate.
Yeah, the interest rate that in net present value, we call it opportunity cost. Got it? In this case, instead of calling it opportunity cost, we're going to call it yield to maturity. Okay? And imagine, guys, so let's do a couple of exercises. Okay, so let's do A. So remember, this is the percentage, the market percentage, right? So this is what the market is requiring, market driven. This is what the market requires. This number changes, guys. Every single day it changes, okay? So let's assume the first situation. Guys, I tell you, the yield to maturity is 10%. Can you please give me the price? Okay, let's do a second scenario. Assume that the yield to maturity, the market is requiring for this type of bonds more than 10%, 12%. Give me the price. And finally, let's assume that yield to maturity is 8%. Okay, can you please give me the price? 3 minutes to do that. It's a very simple discounting exercise. Okay, some questions, some answers, guys.
I got 100 for a
140?
100. This oh,
Sorry, I didn't hear you very well.
100. I
100.
think.
Yep. Okay, you got 100 here. Someone else? Guys, this is a purely simple discounting exercise, guys. There is nothing more. A discounting implies I will discount this 10. Okay, 1.1. So remember, please, guys, this 10% is not the coupon, okay? It is a yield to maturity. In this case, they happen to be the same, but this corresponds to yield to maturity. Plus another 10 divided 1.1 square, correct? Plus the last one, that is 110, 1.1 cube. Agree with me or not? That's what we're doing.
Sorry, we're trying to find
This one.
the price. Is it P's price?
Yep.
Okay.
Guys, do you understand?
Yeah, yes, bro.
Okay, perfect. What about Valentina, Mariam?
Yes.
Okay, perfect. So, and indeed, you should get 100 here. Someone can corroborate this. Daniel already gave me 100, but this should be 100. Yes or not?
Yes, yes, it is.
Perfect. Okay, so what value do you get here when you have a 12%?
I'm sorry, before we move to the next one. So for this first exercise, we didn't use NPV formula, did we?
No. We're using the
We didn't,
present,
yeah.
the present value formula, because remember, we don't have for NPV. You need to have, for example, 1,000 here.
Yeah, so yeah, that's what confused me. Yeah.
Yes. Okay. So here, what we do is basically, as soon as I don't know this one here, what we do is remember is what is called the present value.
Okay.
Okay.
Just a
Simply-
regular present value.
Exactly. Just a regular present value. We discount. That's what we do. We just simply discount. We don't do the net present value because I don't have this value here. Okay, so what do you get here? Someone got something about 12%?
I got 95.2 or 95.196.
Yeah, 0.2, let's say 0.2.
Yeah, I got the same.
Okay, perfect. So the exercise is extremely similar, guys. Remember that the trick, please, that the trick is don't confuse between the coupon and the yield. The coupon is simply to compute the coupon rates. The coupon rate, sorry, is simply to compute the coupons, correct? Once you use this one to compute the coupons, then you're done. You don't use it anymore. The one that you're going to be using all the time is the yield to maturity. The yield to maturity is the one that you use for discounting. So in this case, it's going to be divided by 1.12 plus 10 divided by 1.12 square plus 110 divided by 1.12 cube. Correct? And as soon as I have two of your classmates getting 19.5, I assume it's 19.5. Can you please verify? Okay. Okay, finally, what is the price? What should be the price if the yield to maturity is 8%?
I got 105.15.
0.15. Someone to confirm?
Confirmed.
Yep, perfect. So basically what we're doing here is 10 divided by 1.08 plus 10 divided by 1.08 square and plus 110 divided by 1.08 cube. So please verify this number. Make sense? So guys, how do we call when yield to maturity equals the coupon rate, the bond is called par bond. When yield to maturity is larger than coupon rate, this is called a discount bond. Because you can see the price is lower than the face value. Par is because the price is equal to the face value. And obviously what happens when yield to maturity is smaller than the coupon rate? So we have a premium one.
Sorry, what does it say in the first one?
Par.
That one.
Yes, par. This one, PAR.
PAR?
Yep,
Okay.
par value. So basically, if we have times here, price here, so this is par value. This is a discount, and this is a premium. Okay, but what is interesting, guys, is that in the future, so imagine maturity is here. In the future, all the prices go to this price here. This is maturity. At maturity, guys, all the bonds, the price of the bond is exactly the same as the face value, always. And of course, the road from this price, for example, as a discount to the face value in the future is not as smooth as my graph. So according to the market, this can go like that, this can go like that, you know. But in general, not in general, always you finish in here. Make sense? So when you hear about par value, discount value, and premium value, you understand what is going on. The market is higher, the market is lower. Okay. Questions? Do you have questions, guys? No? Okay, 1 minute to copy and then we can move.
Professor,
Yeah, go ahead.
I recall that it's technically possible for yield to maturity to be negative, right?
Yes.
In other words, yeah. In other words, like you're paying more, but even after you get in the entire payment of the bond, you still lose money.
Yeah, you can lose. Remember, this is what happens in March 2020. So the yields become negative. Okay, so this happens, but it's very strange. But this happens in extreme stress situations. Happens. Okay. Okay, guys. So now, guys, that you have when you can have a negative yield, but suddenly the price is moving your direction, because if you have a 10-year bond, you can be losing now, but perhaps in 1 year you're going to be reverting your loss, right? And that's a good point. So let's start talking then about sources, gains from trading. So let's talk about, there was a good question. So gains from bonds. Okay, the sources of gains from bonds. So let's assume the following example, guys. So let's assume that the bond has a lot of life already. So it has been in the market for long. And let's assume that the coupon rate is 10. Okay, so, and the bond continues. So assume, guys, that you bought the bond here. Let's assume that you bought it at 95. Okay? You bought the bond at 95. You understand? And then you keep it for 2 periods, and in the second period, you sell it for, let's say you sell it for 97. Do you understand my game? So I get into the market, I bought at 95, then I receive one coupon, then I receive the second coupon, and at the same time, I sell the bond at 97. And the bond continues. Its maturity should be in the future. Got it? So what sources of gains do we have? The first of all is what, guys? Interest. Do you agree? So basically, here we call coupons. How many coupons do we receive? I have 2 times 20. 2 times 10. So I will make 20 in coupons. Agree with me, guys? The second source of income is something that is called the capital gain. So what is a capital gain? Is simply the difference between the price, the selling price versus the buying price. So this is going to be simply 97 minus 95. So I will be making 2 in capital gains. And finally, guys, there is another source of income that is called interest over interest. Okay, and for this one here, let me assume that savings account pays you, let's say, 2% per year. I'm just assuming this, okay? So let's assume that this is period 1, period 2, and these ones are years, just to make it easier for us. So basically, what I'm assuming is that this 10 is going to make some money, correct? This 10 here, coupon number 1, is going to have a 0.02. So it's going to create 20 cents. Okay, so all the sources, at the end of the day, guys, you're going to end up with 22.02. So these are all the sources of gains or income that comes from bonds. Okay. Questions? So now let's go to pricing. I think if you have understood this part here, we can go now to pricing. And you're going to see how easy is this one here. So let's do, it is 7, right? So let's do pricing. Okay, and I will talk about something that is called the dirty, clean, and accrued interests. You're going to see this in a minute. Okay, so let's do one example. So let's assume that you have a bond. Okay, so let me draw. Okay, and then of course this is the bond will have it will pay 3%. So the coupon rate is 3% each 180 days. Okay, let's assume that the face value equals $10,000. Okay, let's assume, guys, that the yield to maturity equals, let's do something simple. Yeah, let's assume 3%. 3% too. Got it? Now, what is interesting, guys, okay, let me write. This is 180, 360, 540, 720, and just let's stop at 900 days. Uh-oh, no. Why? So forget about that. I will don't do that. Okay. So, and then when you buy the bond, you don't buy at day 0. You buy the bond at day 60. Here is where you buy. Okay. You understand? So I'm in day 60, and here is where I buy the bond. Can you please construct the cash flow of the bond? Can you please compute the bond? Okay, the cash flow of the bond using the coupon, and then compute what is the price if the yield to maturity equals 3%. So let's say 5 minutes to do that. So what you need to do, guys, is simply build the arrows up, correct? And then you simply discount everything to day 60. And then you give me the price, right? Do you agree?
Yes.
Yes.
Perfect. So you have your cash flow here. Then what we are going to do is, guys, we're going to discount this into this period, this into this period, this one here into this period, here, and here, correct? That's all the exercise. So how do I discount this 300 here? So this is going to be 300 discounted by, this is going to be 300 discounted by something. All of them are going to be discounted by something. So I discount this by what?
1.03.
Yes, but remember, guys, the 0.3 that I'm using, the 3% I will be using down corresponds to, sorry, let's put this also each 180 days, okay, just to make it easy. This 3% we're going to be using here, guys, corresponds to this 3% here. Okay, please be careful here. It's not this 3%, it's this one here. Okay, so it's going to be discounted by 1.03 to the what power?
120 over 180.
Exactly, it's going to be 120 because how many days do I have here, guys? It's only 120. Agree? Guys, do you agree, yes or not?
Yes.
Yes.
Okay, so this is going to be 120 over 180. So this one here is going to be 103. What goes up? Up is going to be
300.
300 over 180. And this is going to be 1.03, 480 over 300. Sorry, not the 300, 180. Why is it erasing everything? Okay, so this is 480 divided by 180. This is going to be 103. What is that? 660
Yes.
over 180. And this rate here is going to be plus 840 over 180. Everyone agrees on this, guys?
Can I clarify? So the price changes even if the coupon hasn't been
What price?
given. The price at the moment when you bought it at 60.
No, it does. Oh yeah, it changes on time. Remember that. So the price changes regarding to this number here and respect to the maturity. Okay. So the price at the end of the day, guys, is the sum of all these numbers here. That's all. So what I'm doing is I'm discounting this 300 here, this 300 here and here, this here, here, and here, etc. So what we're going to be doing is simply moving. That's why this 10,300, for example, moves 1, 2, 3, 4. So 4 times 180 plus 60, that is equal to 840. And as soon as my rate is equal to, is for 180 days. So that's why we have 180 always below. Okay. So can you help me with these computations? So let me rewrite this just to be sure you are able to see them. So this is going to be 60 over 120, 180. This is going to be, what was that?
Sorry, Prof. Isn't it 120?
Oh, sorry, this is 120. 120, so this one here is what, 300?
3. Yes.
Over 180, 480, 600, yes, that's it. Okay, so can you please help me with this number? So this is equal to what? This is equal to what?
I get, like the total, I get 10,099.02.
Yes, can you give me the individual numbers so we can you all help me guys with the individual numbers? 2 minutes and then you tell me please. Just do the individual numbers, just to be sure that everyone gets the same numbers.
Can I clarify? I guess the intuition to why
The intuition is very simple.
we're
We are discounting. So remember, the price is simply a present value. Do you agree? Of all these cash flows. That's all. That's all what we're doing is we're discounting the first cash flow. So instead of putting this in a line, I'm writing them in a vertical form. Instead of using the previous form. So this should be 300 this plus this number here plus this number here. So we are simply discounting every single cash flow into period 60. That's all what we're doing.
okay. Like this goes back to time transformations, right? That we had earlier.
To what?
We had the time transformation.
Oh, the time transformation works for this one here. Yes.
Yeah.
So basically, this 103 corresponds to 180 days. Do you agree? Remember, down. But I'm interested in. So I'm interested in a rate for 120 days. Correct?
Yeah.
That's what. So this one goes up. So that's why we have. I don't want to do this -1 because I don't need to do that. I just want 1 point or something. So the 120 goes up. The 180 goes down. In the other case, I want to know what is my rate for 300 days. So it's going to be 103. This is still 180 days, but I want now 300 days. So this is a time transformation, exactly that. So that's why the denominator is always 180, correct? And, and the number that goes above is simply you accumulate 120 plus 180 is 300. 300 plus 180 is 480, etc. So the time transformation goes down. And I'm simply updating or discounting the rates. Make sense to everyone?
Yeah.
Okay. So please, if you can help me with these numbers, a couple of minutes. Okay, guys, can you help me?
The first one is I got a 294.146.
1.5. Yep.
Yeah.
The next one.
Uh, 285.58.
5.8. Yep. Guys, you need to be following these numbers, please, when you are able to replicate, because this is going to be part of the exam. You need to be able to replicate everything we have done. So these numbers here must be correct in order for you to practice and verify your answers. Okay?
Next one's 277.26.
2.6. Okay. This one.
269.18 or 269.185, so 186 or 18.
Yeah, 1.9.
1
Yep,
point.
9.
Oh yeah.
Yep. And the last one, 10,300 divided by all this number.
42. 8,972.84.
84. Someone to verify, guys. If you sum, what do you get? You get this number, 10,099.02.
And can you please repeat the last number?
8,972.84. 8,972.84. Someone to verify these numbers?
Yes,
Yeah.
that's correct.
Perfect. So if you sum, you get to 10,099.02. Kind of.
Yeah.
Yep. Okay, perfect. So what do you see? What is the problem here, guys? Remember, I told you, if the yield to maturity equals the coupon rate, so how do we call this bond?
Par.
Par bond. So this implies that the face value should be equal to this value here, correct? So what is the problem? Well, there's no problem, guys. The thing is the following. This one here is called dirty price. Okay, and the dirty price is going to be equal to the clean price plus accurate interests. Okay, and the clean price is the one that is going to be equal to the face value. But let's understand what is the accurate interest. So let me delete this part here. Let me delete this part here. And let's talk a little about the accurate interest. So guys, let's focus just on the first part. Let's focus what happens in the first 180 days. So I have here my 300. I have here my 180 days. And I've done the transaction in period 60, correct? If you can follow me and then you can have time to copy. Do you agree with me, guys? So I'm just focusing on the first part here. Now, the question is obvious, guys. Do you remember this 300 corresponds to a payment for someone that gave the money here up to here, correct? However,
Sorry, again. I'm sorry.
so these 300 are a compensation for someone that lent the money at period 0 and kept the money up to 180. Okay? However, the initial buyer sold his position at here. But this implies that this part here corresponds to what? To the seller. Correct? Guys, do you agree with that or not?
Yeah.
Yes.
Okay, and this part here corresponds to you as the buyers. So basically what we need to do is we need to divide this 300, how much goes to the seller and how much goes to the buyer. Now, first thing to remember, how do you compute the coupon? The coupon, guys, is going to be simply 1 plus the coupon rate. Okay. Well, it's going to be, this coupon rate is 180 days to the 180 days minus 1. And then you multiply this by the face value. Correct? That's what you do. So basically your coupon was equal to 1.03 to the 180 over 180, because you give coupons every 180 days, minus 1 times $10,000. And then from here, you can see that the coupon is indeed $300. Correct? Okay, so for accrued interests, so I will call it AC, we use the same formula. For this one here, we use the coupon. But the thing is that, okay, the coupon is for 180 days, but I'm just interested about the value on 60 days, this part here. Minus 1, and then I multiply this times 10,000. Got it? So please, careful for the accurate interest, I'm using the coupon rate. So can you tell me this value? Can you compute this value, please? So the coupon rate is 0.03. So this is basically 1.03 to the power 60 over 180 minus 1 times 10,000. So what do you get here? Someone?
$99.02 is what I got.
Yep, excellent, excellent. So what is this 99.02? So this is what corresponds to compensation for the seller. Do you agree? So basically what we are saying is that from this 300, 99.02 go to the seller, so to this guy, and the remaining part, so almost 200, stays with you. Got it? So now, guys, from here, the clean price is going to be equal to the dirty price minus the accurate interest. Oh, it's not the accurate interest. Let's call it AI, not AC. Accurate interest, okay? So basically what I'm saying is this is equal to 10,099.02 minus 99.02. So what do you get?
10,000.
Exactly. And this is equal to the face value as expected, because these two rates are equal. And this one is called par bond. Okay? Make sense?
Sorry. So in the real life setting,
This is real life setting.
Yeah. So when I buy the bond, for example,
Yeah.
from you,
Yep.
you'll keep the $99 and I'll
Exactly.
keep the rest.
Exactly. So you pay me now the $99. You see?
Okay.
So this
Sorry.
19. So
Yeah.
remember, what you pay now is this amount of money. You are gonna pay me $10,099 now in period 60. Make sense? So from this $10,099, 99 corresponds to my part of the 300, and the 10,000 corresponds to the price.
All right. So okay. So how it actually would work is that I'll buy it for you for 10,099.02, but I'll also receive the entire 300 coupon. It's just that
Yes, when you arrive to period
technically,
180,
that's what I was thinking.
yes, when you
I
arrive
thought
to when you arrive to period 180, you're going to receive 300.
Yeah.
Complete 300. Okay, but you know that from this 300, you have already paid in advance $99. That corresponds to the seller. Right? That's exactly correct. Okay, guys, questions? Okay, copy, let's do one exercise. You do one more exercise, okay? Just to be sure, and then next week we're going to review more topics on what we have done up to now.
Professor, the term dirty and clean, this is just for this particular, the terms dirty and clean, it's just for this particular bond pricing, right? Because I remember when I was working before First City, when we used dirty and clean, it meant different things.
What do you mean 13 thing? What is that?
Like dirty was like
dirty price. This one here.
Yeah, dirty price. Yeah. Like dirty was like the day one, or like the price or the P&L you got for that day, while clean is like the existing P&L that you've got, something like that.
No. The dirty price is simply the price of the bond at time that when you are going to buy it, including the accrued interest. That's all. That's all. What is the dirty price? And this is normal nomenclature in bonds. Always is the same.
Okay.
Okay. Okay, guys. So you do another exercise. Okay. Questions before we move. So let's verify that you can do one more. Okay. So let's assume example those. So let's do this in 10 minutes maximum. Okay. The logic is going to be exactly the same. So let's assume, guys, that. Okay. So let's start at. Yeah, let's do the same. So it's going to be simpler. Okay, so let's assume the coupon rate equals 5% each 180 days. Let's assume the yield to maturity equals 7% each 180 days, just to make it easier. Let's assume that the face value equals $100,000. And let's assume that you buy the bond on day 160. Okay, so you are here. So I want the price of the bond here. And then this is on the maturity, this is the maturity day. Okay, 10 minutes to do this, guys. It's exactly the same as before. It's simply different yield. You just need to be sure that you understand the use of the yield when you use the coupon rate, etc. 160 day, you do this. Okay, 10 minutes. For all, okay, the accrued interest and all. Nope. Okay, guys. So next week, what we are going to be doing is basically working on exercises. So I need to be sure that you understand all what we have done. So if you can study this as a practice for the exam, of course, the exam is farther in time, but it's good if you start practicing. And if you have questions, ask me the questions. Okay. Make sense? Okay, guys. So
yes.
See you in a week then. Take care and study, please.
Thank you very much.
See you, guys. Take care, guys. Bye.
Bye. Thank you.
Professor, I have a question before I
Yes,
leave.
Valentina, yes.
Um, Tú hablas español, ¿verdad?
Sí, 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 hablo español.
Ok, súper. Te quería preguntar, es que